Welcome to Business Mastery with Don Kennedy, your quick under 45-minute dose of expert insights and strategies to make a positive impact on your business and life. Let's get started. Hello, and welcome to this episode of the Business Mastery Podcast. Today, we're talking about investors, outside investors. We're going to talk about angel investing, and we're going to really kind of take the veil down, if you will, from what people think they may know about outside investors in your business. I have Anmol with me, and we're going to dive into this topic. So thanks so much for joining me today.
Oh, thanks for having me. Looking forward to chatting with you.
Yes. Can you tell everyone who you are and who you serve?
Definitely. So my name is Anmol. I'm primarily a stock market trader and investor, but I also invest in startup companies and have, real estate business as well, and Airbnb. And I wrote the book, Prepping for Success, 10 Keys for Making It in Life.
Fantastic. All right. So let's talk about investing in small businesses. So from your perspective, we'll get into kind of what you look for, but let's just kind of clarify the different types of investors, right? An angel investor versus somebody who comes in, for other reasons. And so let's just talk about that. Can you give us a little bit of a download on the different types of investors and what makes them different?
Yeah, definitely. So there's, many different types of businesses that people can get in their companies. So an angel investor is somebody who typically comes on in the early stages of your company. That's why the term angel is concerned, was coined, is that you are looking to invest into a company that's, fairly new or just getting up and running, and they're just looking for kind of like an angel to come in and to fund the business so that they can supercharge their, business growth and kind of shorten the learning curve. But even angel investors, there's many types of investors. So majority of the people are going to be silent investors, meaning they're just investing in the money for either equity or some other method. And then they don't have a say in the company, but they're going to have a piece of the company should they get acquired or should they go public or, or distribute, dividends or something along those lines. And then there's also active investors. Active investors are people who are typically putting in their money as well, but they're also part of the growth of the business. So either they have advisory shares or advisory role in the company. So they will get compensated for their advisory role as well as for their investment. And they're typically much more involved in the growth. They're making active connections and, they're introducing you to people. And typically Shark Tank would be considered in that category. So they are putting in the money, right? But they also have a say in it. They're introducing you, making connections with people. So those are kind of the different types of investors. A seed investor is somebody who comes in like right in the beginning. That's planting the seed. That's where the term comes from. So that's a seed investor. And those are different types of investors that come in different stages of companies' growth, whether they're Series A round, Series B, C, D, and so on and so forth.
All right. So a lot of companies don't start off with outside investors. A lot of them are either bootstrapped or they'll take like an SBA loan or something like that. Let's talk about the benefit of actually having an outside investor take an interest in your company, even from the very beginning.
Yeah, so there's many advantages and disadvantages. The advantage, obviously, is that you get a burst of capital coming into your company, helping you grow. So then you could use your the existing money or the existing income in the business to, in fact, reinvest into the business and keep growing it faster, right? Because now you don't have to worry about using your money to pay all the bills and the salaries. Investor money could be used for that, and then the other investor, the money that you have, you're using it to grow it. So the advantage is that typically it cuts down the time. Like a business might take, let's say, it takes a few years for them to build up the capital to reinvest and grow, but now they're having the capital come in, which supercharges the growth. So that's the advantage. The advantage of getting an active investor is actually much better than just getting the money. For the most newer, business owners, I always tell them, try to do as much as you can without taking any money, right? Because you are going to dilute yourself. You are going to give away a piece of your business. So try to do as much as you can first before looking for investors. And if you are looking for investors, ideally the better ones are that are also bringing something else in addition to the money. Because if it's just the money, you could get a loan, you could get all these other ways of raising the money without giving away your business. But when it comes to getting an active investor, that opens a lot of doors because they might get you in rooms that you might not be able to get into. They might make a connection. They might be able to make a call to a supplier or to a vendor and get you that deal, or get you in front of other investors as well. So that's benefit. And if somebody is trusting you to put their own money on the line on your business, that's also sort of a validation for your idea. right? And hey, it's not just me. Somebody else believes in my idea too. So that does give, the entrepreneur a lot more confidence in his own business that other people are willing to believe in their idea as well.
Yeah, you brought up Shark Tank, and I think that is probably the more well-known idea of an active investor, but you don't have to go on Shark Tank to find someone to invest. So it's you are looking, let's say you're reaching a skills cap and you need some support and you need to expand and grow. Where can you find someone who would be an active investor?
Yeah, there's three ways you can go about that. So number one, there's many crowd funding websites like startengine.com, there's republic.com, wefunder.com, microventures, equifund. So there's a lot of different websites where companies can go and list their business model, their business idea, their pitch deck, what they're looking to raise, how they're going to spend the money, what they're going to use the money for, and then how the investors can hope to get paid back, and what their overall idea is. And just based on an idea, that those websites have millions of users. So people are putting in different amounts of money. Some might only put in 10,000, some might put in 5,000, but some websites allow you to put as low as 50 or $100, right? So that you don't have to look for that one big investor to come in. You can raise the money through the crowd, and right, with smaller investments, but still being able to get to your funding goal. So there's websites like that. So that's method number one. Method number two is you actually going out there and attending your local business meetings, right? Going out chambers of commerce meetings, attending all the networking events, right? Attending pitch fests where you can come in and pitch your ideas to investors. So there's a lot of different networking events and conferences that you could go to, where you can meet people, you can share your idea, and then also raise money, right? Now the third way is so the third way is, basically the same method, but now you're doing it online. Like you're browsing investors through LinkedIn. You're going through their profiles and seeing, okay, this person seems to invest in financial businesses. I have a financial business. Let me get in touch with them. And you're just typically trying to, get them on a call. Hey, I'd love to share my business idea with you. Here's a little pitch. All right, the deck that we prepared. If it's a good fit, let's get on a call. Right. So those are the kind of the three ways typically you would find investors.
Okay, so you can actually find investors. Investors are actively looking for businesses then as well, so they would put it on LinkedIn, for example.
Exactly. Because if it says angel investor in their bio or profile, that's a good one to reach out to. Because investors like me, we're also looking for deals all the time, right? We're always looking to evaluate deals. We're always looking for deal flow. That's the hardest thing for an investor is to find good deals. So we're never opposed to sending deals, right? I think I get people emailing me their pitches all day long, right? And I have nothing against it because, sometimes I might look at a bunch of them and I see, you know what, that one looks interesting. Let me get on the call with them and learn more about that. So yeah, investors are also looking for deals. There's also different angel investing groups and organizations that you can go and speak at. So those are also, methods to look at.
All right, perfect. So now let's talk about what makes a good deal for the investor and what you are specifically looking for. Because again, you are going to put your own money in and maybe have an advisory role, but what are you looking for?
So there's many different things, but I think the first thing is, the entrepreneur itself. Like what is their track record? What is their background, right? And then also getting a feel for their mindset, right? So when I get on the call, before I even look into the business or if I look into even the concept of the idea, the first thing is the entrepreneur. Because you could have the best idea in the world, but if the entrepreneur is not in it, and the heart's not in it, or if there's just like a thing they're trying, or it's like, oh, I just want to make money, I want to sell this company, those are kind of red flags for me. If the first thing to talk about is we're going to sell this company for this much, that's a big red flag. Like I want somebody who's passionate about his business, and selling it is the last thought they have, right? Although that's the goal, but it'll be the last thought they would have. Is like for them, it's all about how do we get more customers, how do we change lives, how do we, cause an actual impact in the business in the industry. That's number one. Once I've checked that box and I say, okay, I think that is a trustworthy person. He's going to use the money wisely. Then the second step is, okay, what's the TAM? What is the total addressable market, right? So if it's just a small business, if it's like a mom and pop shop or whatever, then I might not necessarily invest into that because it's a small market. It's not a big size market. And for angel investors, we need outsized returns because 80% of the startups an investor would invest into are going to go zero, right? It's just the way the industry works. They're going to go bankrupt. You're not going to get your money out. So investors are relying on that 10% of those businesses that they invest in. They're going to not only make up for all of that, the other 80%, but they're going to bring us some return. So the TAM, the total addressable market, needs to be big enough so that we can see the growth. Examples are, let's say, Uber, right? If you put in $100 in Uber as a seed startup stage company, that'd be worth $1 million. So we're kind of looking for those type of outsized returns. So that's number two. And number three is I want to see, okay, are they just raising the money or do they have the plan for it? Like, how is the money going to be used? Like, what are you going to use it for? And how does this money now result in you achieving your goals that you set out? Like, how is that going to translate? So that's number two. And then third thing, as we get further down the due diligence process, then it's going to be looking at, okay, how have they used the money that they already had previously so far? That gives us good indication of, how their financial literacy is and how they're actually going to spend that money. And then the last thing would be like, okay, how do I get the money back? Right now, is it in a form of you gonna go public? We're gonna get IPO. We're gonna get a stock. Or you have a plan on maybe it's a potential merger target or acquisition target for another company. Or thirdly, you're incentivizing your investors with either royalty or dividends or a percentage of sale or something along those lines. So that's kind of like a sort of like a framework you follow, but it all starts with the person who's running the business first, the entrepreneur, the team behind it, and where their mind is at.
All right. So you are also looking then for additional information that would be outside your average business plan, right? So if you're going to write your business plan and take it to the bank, you're going to do some competitor analysis, things like that. You're actually looking specifically for, like you said, total addressable market and things like that. Where do people, let's say someone's going, I really need money to scale. I have this idea. I've been in business 2 years. How do you get that information? Because that's not going to be something that the bank is going to ask for if you're going for a loan.
Yeah. So I mean, if it's, let's say, a smaller business, let's say they have their first gym location, right, and they want to do more. So then we'll look at, okay, in that area, what other competitors are there, what other gyms are there, and then trying to look at, okay, what kind of memberships do they have? Is it full? Is it busy? What's their membership cost? So then you can kind of figure out based on the flow of people coming in and out every day, multiplying that by the amount that they charge for membership fees, and you can sort of estimate, like, you're not gonna get an accurate figure. You can get a ballpark figure on, okay, this is what the expenses would be like in the area, the rent's about X amount, and you can kind of get a ballpark of, okay, this is what a good profitable gym can produce. So then you can do that. Okay, if that's one location could bring in X amount, then what if they have five? What does that look like? And you can kind of run those projections. And then the goal is, okay, is it gonna end up being a franchise? Like, what's their model? What are they looking for? Are they gonna just grow themselves internally, which is great because they get to keep the full equity, but also the growth is gonna be much slower for them to get from one location to 5 or 10. Whereas with the franchise model, sure, they give away some of that profit, but the scaling can happen much faster. And in terms of the investor, for us, it's not really totally about the cash flow in that business, but what is the total net worth of that business now that they have 10 locations, 15 locations? What's the company brand value go to? So I think those are some of the ways you can use to sort of estimate a ballpark. But with the small and mom and pop businesses, they don't necessarily have clean books, right? They don't necessarily have everything tracked or systematized like a normal business would. So the first thing would be to set up SOPs, standard operating procedures for them.
Yeah, and getting all that done. Okay, so perfect. All right. So we know what you look for in an investor. What should somebody seeking an investor, besides something like an industry match or a dollar match, what else should we be looking for if we're seeking an investor?
Yeah, I think first thing is to get clear on, are you needing money or are you needing help or are you needing a mix of both? That's a good clarity to have because a lot of times entrepreneurs would think, if I just get more money, it'll solve the problems. And then, they burn through the money very quickly. Happens all over the time. So you need to have a plan. Okay, is it just the money that I need, or maybe it's the connections that I need? And sometimes connections are more valuable than money, right? Sometimes the connections might open you a door that you was previously closed, and that just the connection can actually get you to your goal rather than needing even influx of capital. Because as you get one location, two location, three location, now the banks see that you have a lot of collaterals. You can just go to the bank at that point and you even get that money. So you have to do the math on what are you exactly looking for, get clear on that. And once you figure that out, then you look for, okay, is the investor on board with my vision? Like, do they actually believe in the company, or now is the investor just in it to make a quick buck? Right? That's also really important. It's like how investors are evaluating the entrepreneur. the entrepreneur should also evaluate the investor, because what you don't want is a whole lot of trouble, right? Like, the legal documents, they send you like a 100-page contract. Now you got to go through, maybe they tie you into some deal. And that's what happens with Shark Tank sometimes, right? They take a percentage off, like, oh, this is going to be a finance deal at 5% interest, and I'm going to take a royalty of dollar per thing. You got to be really careful that you understand what you're signing and what you're getting into, right? Always get an opinion from a lawyer or something on that deal. And then, evaluate the investor. Is that something you would like on your team? Do they align with your values? Do they align with your goals? Do they align and actually believe in you and the vision? So I think all those things come to look at, okay, if you need an investor or not. But I personally always tell people is like, if you're going to get an investor, but then ideally in the early stages, you want somebody who's actually going to be on board with you and help you grow it. Even if they're not getting advisory shares, maybe they get on a call with you and say, you know what, here's what I think you should be doing, or maybe they connect you with something that's more valuable than any money you could get.
Yeah, fantastic. So let's talk about the length of time for some of these contracts. Like you were saying, investors aren't typically going to be in there for like 20 years. They're not going to necessarily be, passing down maybe the company to children or grandchildren, right? So what is the average time that an investor typically would stay with the business? Is it till they recover 80% of their money and then they go a little more hands off to recover the rest? How does that work?
Yeah, so I think for me, majority of the investments that come to fruition, um, I think it's typically about the 5-year mark is kind of what we're looking at. So we're not really concerned about getting the money back this year, next year, 3 years, but typically the 3 to 5, 5 to 10 year horizon is where we're looking to at least get something out of it, whether you go public and we get shares. So now, even if we're not selling the shares, but at least it's a liquid investment, we could decide in the future what we want to do with the stock. Or if, like, that this could be a candidate for acquisition or, purchase or consolidation with a bigger company, those type of thing. But as far as timelines, 5 years, 10 years, typically not more than 10, unless it's a huge idea like an Uber or like a, social media company like, Reddit or something invested in, then those could have a longer term time horizon. And investors, even after they get their shares at IPO, they rarely sell those. So those are like lifelong investments. But if it's like a business, a shop or gym, a local business, or if it's something like that, then typically 3 to 5 years is kind of the horizon where we want to get something coming back, whether it's in the form of royalty or dividend or something.
Okay, perfect. So yeah, you're in it for a long enough time, but you're not actually in it like as if you were coming into the partnership of the business and now you were like a 50% equity shareholder or something like that. Okay, perfect. So next question beyond the idea of when you need an investor or how to find an investor or whether you're a good fit or when you get out, what do people misunderstand or misconstrue about investors in business that you see most of the time? Because I can't think of all of the examples, but I know that there's a lot of misinformation out there about investing. And I have seen pretty negative things about how they steal your business and things like that. And I just want to see from your perspective, what do you hear the most and how can we correct those perceptions?
Yeah, I think the biggest perception usually is like, what are they looking for? Are they gonna tie me into like a contract, or those type of things. But all those things are easily avoidable. Like if you set your expectations up front on what you're looking for, and rather than letting the investor make you a deal, like you offer them the deal that's suitable for you, and then you work with that and you negotiate through that deal. And so I think a lot of that comes down to the entrepreneur's negotiation ability too. The negotiation is a big part of the making, at least big deals. Negotiation is a big part. You might start the conversation with 10% equity, but maybe you can negotiate and get it down to 7, percent or 5%. But yeah, so I think that's a couple things. The other ways you could do that is through advisory shares, or you give them like a convertible note that once we hit this valuation, then it converts into equity. So I think I would always tell entrepreneurs is like, rather than trying to learn all of this yourself, just, get like an advisor or somebody who's already familiar with these contracts. Give them like a percentage, a very small percentage, just for advising, even if it's 0.5% or something, just like in the form of advising, and let them handle that. Because one thing that I've noticed at least is a lot of entrepreneurs, they get caught up in the fundraising world, right? They keep raising money, they keep going to networking events, and all they're about is like raising more money, and then they forget the business in the first place. And
Right.
I had experience a few years ago, I think 3 or 4 years ago, I had this entrepreneur come for a meeting, and it was just, hey, I'm just in New York, I'm meeting investors, raising money, and then I'm following him on social media. Next week is in San Francisco, going to some investor meetups and conferences and raising money. And I'm following his Instagram. Like he's traveling all over the country, these different events. I'm like, who's working on the business? Right?
Right.
Because the business, you haven't posted anything on your business Facebook page for the last 2 weeks. Like, so what's going on? Like, how would I ever trust somebody like that if it's all about raising money? And there's a lot of investors that caught up in the world. If I just get more money, and they just keep burn through that money really fast. So that's a red flag. I think so. It's better to get somebody whose sole job is to go out and pitch your company and raise money. Give him percentage to do that, or percentage of whatever he raises, and you focus on your own business.
Yeah, I think they would also be, of course, much more familiar with the type of pitch deck you're looking for and the information that you need, rather than again you trying to convert your business plan and your last 3 years of balance sheets into something that you would be interested in seeing. So, where do we find these kinds of advisors? Are they also on LinkedIn? Is this a I'm familiar with consulting, but is there investing consulting sort of a role that's pretty familiar? And are there people that you routinely work with that, our listeners could go look for, not necessarily a particular person, but a particular role, to help them with navigating this?
Yeah, definitely. I think there's again several different ways. First way is, okay, make a dream list of people you'd love to have. Maybe people in your industry that are pretty popular, doing really well. Maybe you find people through your networking events that I've mentioned that they have advisors in other companies. As you speak to other entrepreneurs, LinkedIn obviously is a great way. Like if you know somebody who's going to be a good help for your business, reaching out to them, saying, I'd love to have you on board. Not looking for any investment. I'd love to chat more and offer you percentage of the business if it's a good fit. So LinkedIn networking events, and again, you also probably know in your own industry what other people to network with or shake hands with. Reaching out to them is a possibility. The other way is, as I mentioned, those other websites previously, the start engines, the WeFunders, the equity funds. If you go on there and you go to other, your competitors maybe, or people in the same industry who are also raising money, you can go down the list and see who's invested in that, who's invested more, who's the lead investor. And oftentimes you can reach out to those lead investors and say, hey, would you want to be my lead investor? Right. So I think, so you can go through other people's investments because all public information, and reach out to those lead investors. Say, hey, would you like to lead my round as well? And offer you percentage. Yeah.
Yeah, very cool. So inside of those websites, what information do you need? So does the pitch deck need to be pretty similar? Does it need to, because I don't want people assuming that if they're going to go crowdfund this, that they don't have to, like, the due diligence is still the same, I would assume.
Yeah, it's the same. In fact, maybe even better because with a one-on-one with an investor, they're going to ask for certain things. They're going to send them that. But when you list on those websites, they have very specific criteria. So you need to provide your financial statements up till date. You need to provide what your pitch is, the business idea, the business model, how the investors hope to get their money back. What are you offering them for that investment? And they're very specific criteria. But the good part about these websites is because they're also the way these websites make money is to get more companies on and more investors on. So they help you a lot in the process. So when you're listing them, they guide you through, okay, here's what you need. Here's all the documents you're going to need. Here's all the financial disclosures you're going to need. You're going to have the contracts ready. And then you just upload all of that. And for an investor, they could just go in and just simply scroll through the page, and you're able to get all the information you need.
Fantastic. Where can people meet you on LinkedIn or find out more about you? I know during the day you said you're a trader, but I mean, you are an active investor and you are always looking for those unicorns, if you will. So, where can people link up with you and learn more about you?
Yeah, I would love to give your listeners a free copy of my book. So they can go to go.unmol.net. So go.myname.net. And then you can just grab a free copy of my book. That's a good way to get started. But then you can learn more about it on my website, unmol.net. And then I'm active on Instagram and X. I guess I'm the most active on. And yeah, my username on both of those is Delta90, DELTA9NETY, spelled out. Yeah.
Okay. Fantastic. So we're going to put all of that down inside the show notes, and we're going to put it down into the description of the YouTube video. And thank you for your generous offer of a free book. That's amazing. So we will definitely make sure that those links and everything are there. Do you have any final words? Because, the investing, I think it's intimidating for people. And I think that there also needs to be, like you said, for the entrepreneur themselves, like you have to be confident in your idea and you need to have, solid solid plan and things. But what else? What are the final things that you should consider if you are at a place where you need capital to grow and an investor is going to be the right decision?
Yeah, I think for the only, I guess, final advice I'd say is try to delay raising the capital as much as you can. Right? You don't like rush into it, because it's oftentimes capital is not what they really need, and sometimes capital is a substitute for them doing the work. Right? Like, are there other ways you could raise money? Maybe, a financing deal, maybe a loan, maybe you giving somebody just a percentage of your sales in terms of that money so they can get paid back without giving the equity. Because I think a lot of people rush into raising money and they give away a lot of their business, and maybe they have something big and they could have done it without giving away equity, but they choose to do that, and now you have more pressure on you as well because you have investors, you have other people's money. So I think try to do as much as you can on your own first. And once you've exhausted all those options and money is the only option left, then look for investors. But try to see as much as you can by yourself first, right? So I think that would be the advice I'd give them.
Perfect. Well, thank you so much for your time. I really appreciate it. And thank you for sharing all of your wisdom on investing. And as, business owner listeners, we are always interested in new and different perspectives. And thank you for taking away some of the mystery surrounding this. So I appreciate your time.
Sure. Thank you. It's great chatting with you.
All right. We'll talk to you next time on the next episode of the Business Mastery Podcast. Take care. Thank you so much for listening to this episode of the Business Mastery Podcast. If you want to learn more about me, you can go to DawnKKennedy.com, and you can now check us out on YouTube as well as, of course, any of your favorite platforms that host podcasts. Take care.